Hi, it's Mark for Realty Capital Finance. This is going to be the 7th video in the series, the educational series for our brokers and borrowers. I would like to discuss today scope of work documents. Now, a lot of our loans are fix and flip loans where somebody buys a property, they rehab the property, and then they sell the property or refi the property for long-term as a rental. Now, I want to discuss the rehab portion. Now, a few things. First of all, we will require a scope of work document, which basically delineates exactly what the borrower intends to do with the property with the amount of money they intend to spend. The scope of work document cannot just say, I intend to do these 10 things to the property and this is the total. No, it needs to be a detailed budget of each line item and then, of course, the total. Now, a few things. First of all, borrowers need to have the experience. Say a borrower shows that they've done 3 or 4 or 5 flips in the past, and their rehab experience is so far been for light refreshes of properties, painting, trimming, this kind of stuff. And their total rehab budget in the past has been $20,000, $30,000. If a borrower is coming along with a rehab budget now of $150,000, we may turn down the loan because of that. A gut rehab is a complete different animal than just a surface rehab, and we need to be able to establish that the borrower has the experience. Obviously, if a borrower has spent $30,000 and now they want $50,000, we will be more likely to okay that. Now, another thing about rehab budgets is that a property that's being purchased for $100,000 with a rehab budget of $200,000 will most likely be turned away. We typically don't want the rehab budget to exceed the basic loan, the purchase loan. If the purchase loan or the purchase price is $150,000, we don't want the rehab budget to exceed $150,000. Even if the ARV, the after repair value, is high, we just we need to make sure that there's enough liability for the borrower. And if we're financing a very large rehab on top of a smaller loan, that is where the balance sort of starts tipping and it no longer will potentially make sense to us. Now, the way it works with rehabs is that the borrower will complete a portion and then call a draw. We don't fund the rehab up front. We fund the rehab as the work has been done. We only lend money with it already in a property. It must be backed by the property. Say somebody wants to do a rehab of $20,000. Once they've completed, say, $5,000 worth of work, they would then ask for a inspection. We have an inspection company that will come out, take a look at the property, take photos, confirm that yes, what the borrower claims they have done has actually been done, and then we will authorize our escrow company to release the funds. If somebody claims they've done $10,000 worth of work and the inspector only sees $5,000, we will only give them the $5,000. In the rehab draws, another area that sometimes can be confusing to borrowers is, hey, look, I ordered all these appliances, I ordered all this framing. If you ordered material and it's in the house, it does not count towards your rehab draw. It must be physically attached to the house. Ordering lumber for framing and it's sitting in the living room is not considered it being already installed. The walls, the rough framing must be up in the house when the inspector comes. The inspector must see that. Just because materials are in the living room does not mean it's going to be installed in the house. We do this to make sure that we are only funding rehab that is actually attached to the property. You may have a beautiful appliance set in boxes, but until it is installed, we will not give you credit for that. Now, typically there are rehabs that are under $250,000. Primarily, they're under that. Under $250,000, providing, of course, that the base loan isn't considerably smaller than that, but is $250,000, $300,000 as well, does not require a committee approval. A large rehab over $250,000 will require a more detailed scrutiny of the person's, both their experience and exactly what is going on with the project, to make sure that it is a viable plan. Now, these stuff take time. Please, brokers and borrowers, understand that this takes time. Typically, it is done as we are doing the appraisal and ordering the appraisal, waiting for it to return, and ordering title insurance. But sometimes there can be holdups when somebody wants to do a several $100,000 rehab in approving the loan and funding before we completely are convinced and comfortable that the person is capable of doing it and that it is a viable plan. Now, sometimes somebody will submit a rehab plan for $100,000, and for some reason, either their experience is lacking or the project won't allow us to fund 100% of the rehab. Sometimes that occurs, and we only will fund 90% of the rehab, say. Basically, the borrower will have to pay the last 10%. The way it works is, every single time they will order an inspection and a draw, we will only fund 90%. If they're approved for $10,000, we will send $9,000. It won't work that we will fund 100% until the last 10%. No, each and every draw will only be at 90%. I want to say, out of all the loans that I've seen, almost always it's 100%. Sometimes it'll be 95%. Very rarely it will be below that. This concludes the 7th video in the series all about scope of work and rehab. Once again, as always, if you have any questions, please don't hesitate to comment on the video and I will respond.